Sam, really happy to have you joining me here. Sam was my guinea pig on the very first fund pitch webinar that I did back in May that kind of served as a proof of concept for the event today. So I'm really excited that he's come back to present his fund once again, his mobile home park fund. So Sam, without further ado, I'm going to turn it over to you. And thanks for joining us today.
Thank you, Jimmy. Can you hear me okay?
I can. You sound great. Go ahead.
Awesome. Yeah, well, I'm glad as a guinea pig I didn't screw it up so bad that that this event didn't happen today. So glad to be back.
You did great.
Sam Hales with the Saratoga Group, and as Jimmy said, we're actually on our third Opportunity Zone fund. All of them, including this third one, focused on mobile home communities. So the Google photo that you see here is a community in Rockford, Illinois that we actually closed on 2 weeks ago. It's actually not in an opportunity zone, but that's actually part of the point is, I often tell people that really mobile home communities probably should all have been included in opportunity zones because they really meet the political intent of the legislation, which was to help people in the affordable housing space, and that's certainly what our business is about. Let's see, give me a second here. Seems to be a little delay. There we go. So this is our team. We are a pretty tech-focused company. My background is in technology. We have others on the team that have that focus as well. And so one of the things that we really try to do is to bring technology into our operation to run our operation more efficiently. Unlike maybe a standard multifamily operator, they might have a lot of geographic concentration. They'll be able to maybe pick a market like Nashville, Tennessee, and have a number of projects in that market. In the mobile home community space, that's a lot more difficult. And so we're geographically, we're focused on the southeast part of the United States as well as kind of the lower Midwest, but still that's a lot of states. We're already in 10 different states, and we get some operational efficiencies in terms of picking some markets, but we're in quite a few markets, and so technology becomes a key part of what we're doing as well. So I'd like to quickly go through the advantages generally of MHC, meaning mobile or manufactured home community investment. The first one is relatively simplified management. So the principle is we have this community, and we're basically leasing out spaces in the community to homeowners, and they own their own manufactured home, and then they pay us a lot rent and pay for their utilities, that sort of thing. And so the repairs to the homes, a leaky roof, leaky faucet, those sort of things are really the responsibility of the homeowner. Related to that is that it's not inexpensive to move one of these homes. Depending on the market and length of travel distance and a number of other factors, it can be easily $10,000 to move one of these homes. In general, across the MH community, the average resident stays in a community about 12 years if they own their own home. The third, and this is an important one, is that there's still significant acquisition opportunities. So there's been entrants recently, meaning over the past few years, Carlyle, Blackstone, other large institutional funds and private equity firms have entered the space, but still they only own a small fraction of the communities, and so we're still able to find a number of communities owned by kind of mom and pop owners and find value in those purchases. In terms of risk adjusted returns, so operating expenses, because we don't own many of the improvements, meaning the homes, then as we stabilize these communities, as we fill them up, we're typically seeing operating expenses that can be below 40%. And then finally, there's a limited supply. So I mentioned the 50,000 communities in the United States. Unfortunately, it's very difficult to get a new community approved to build. And so it, in a sense, creates a moat around the business. You've got increasing demand and yet supply that's very constricted and actually shrinks slightly each year as some of these communities get redeveloped into Walmart or things like this. So this is an interesting slide, and this is actually what initially got me fascinated with the space. I'd heard about this, that some of the public REITs, there's two main ones that focus on manufactured housing, and that since they had been listed on the stock market, this is only going back to 2009, but both of them have been on the market, publicly listed for about 20 years, that each year and actually every single quarter since they've been listed, they've reported positive same-store NOI growth, which you can think about some of the events that have occurred over the last 20 years, including the dot-com bust, including certainly the Great Recession, and now even through COVID. This has been a very durable sector and has continued to have actually growth, not just maintaining profitability, but actually growing profitability on a per site basis. Okay, I won't go through all of the different comparisons here on a mobile home community maybe versus other typical qualified opportunity zone funds, but we're certainly a little bit different, right? It's maybe not as fun to look at, and not as the pictures aren't going to be as pretty, but it's what we're doing is we're diversifying our risk across multiple assets in this fund, which is a $30 million fund. We anticipate we'll be purchasing at least 25 communities, and so we're kind of geographically diverse. We're buying existing cash flow. So our previous MHC fund that we just closed a few months ago, our going in cap rate was about 6.5%, and that was at 55% occupancy across the fund. So certainly a lot of room for infill and improvement to the cash flow, and yet a decent kind of going in cash flow as well. The final point being, the MH communities have traditionally, historically, and even currently do well during a downturn and during a recession. In fact, this is a slide from April. I haven't seen any kind of industry-wide more current information, but everything that has been shared with me from other operators and our own experiences has continued to be resilient in terms of rent collections through the COVID crisis. So again, this is from April, but you can see it was the highest of any of the commercial real estate sectors. And if you think about it this way, you've got a scenario where a resident in your community, they own their own home, they probably have thousands of dollars invested in that home, and the average lot rent across the country is less than $300 a month. Are they acting out of just general human interest? Are they going to give up that investment in their home for a mere $300 a month? And then the question is, if they can't live there, where are they going to live? It's a very important service that we offer in the MH industry. Another thing that has kind of happened here that's relatively interesting is that people are now looking for it used to be, it was all about kind of the urban experience and coming into these gentrifying downtown areas. The trend has certainly reversed, as many of us know, and people are looking to be able to socially distance, and single family housing, kind of that build to rent model that Blackstone and others are doing, that's doing very well. And it's very similar for the MH space. People, if they have their own driveway, they have their own yard, they have their own deck, they're able to have an affordable solution and yet be able to socially distance from their neighbors. So this is just a high-level summary of our projections on our returns for the fund. Obviously, a 10-year hold. There's going to be a ramp up as we acquire these properties over the first 12 to 18 months. But as I mentioned, we're buying existing cash flow, and then we're improving that. We typically look for 3 different areas where we can improve through infill, through operational efficiency, and then through bringing the rents up to market. What you'll notice just real quickly here is we're kind of projecting in the first 5 years, most of our communities we're going to be able to refinance through long-term debt, long-term non-recourse debt, kind of like a Fannie Mae loan. Going in, because these properties are often, they've been neglected, they're not eligible for some of the really fantastic financing that's available for the MH community. But as we fill them up and as we clean them up and we fix the roads and the clubhouses and all this sort of thing, we're definitely going to be able to qualify for that great financing that's available. So what do we do? I mean, what are the actual projects that we engage in, and how do we fix them up? So top left, you're going to see that's a property in our last OZ fund in Bloomington, Indiana. We just redid the roads there about 5-6 weeks ago. That's a common one. You can imagine many of these communities almost undrivable. Some of them don't even have paving, and so we're adding asphalt for the first time. Others, the asphalt's 30 plus years old and really has major disrepair, and so that's a big one. Community members love that, but other ones you're going to see are pouring driveways, bringing in new homes. We always add a children's park, where appropriate. Sometimes there's maybe it's a 55 plus community, it's not appropriate. Bottom left, you can see new signage that we're putting up in our communities. And then, some of them we're putting in soccer fields. We often do a solar light. We've developed a solar street light solution that we've been putting in many of our communities. And so it's repairing infrastructure, and at the same time, it's some of the aesthetics and cosmetics that make it an attractive community. So this fund is actually Fund VII. It's only our 3rd Opportunity Zone fund, but our 7th MH fund, and we have a number of properties in escrow. Actually, 3 of them are going to close escrow here before the end of the year. First one is here on the left. This is you'll see kind of the map on the bottom, and then a photo of the children's park. They already have one at this community above that on the left. This is a 219 site community in Memphis, Tennessee. It's less than half full. It's a beautiful community, and it just needs to be filled up with new homes. There's some disrepair and some tree work and some different things like that, but most of it's kind of prepping these lots and bringing in new homes. On the right, this is a kind of a Google photo shot of a community in Atlanta, Georgia, only 15 minutes from downtown, that we anticipate is also going to be part of this new fund. We also have a couple properties in Nacogdoches, Texas, about 150 sites, and those will close in December as well. And really, that's our thesis, is buying these MH communities, filling them up, renovating them, and maybe I could just leave with this final thought. We talk about this as a firm all the time, and we call it the bus test, which is when a kid gets off the bus at our community, we want them to not be ashamed, but to be proud that they live at that community, and that's the bus test. If we don't pass the bus test, we're not doing our job. And you can go to invest.saratogagroup.com to find out more about this offering.
Awesome. Thanks, Sam. Great to have you here once again. Thanks for joining us today. Got a few questions for you. Going to give you a few more minutes for Q&A, and then we're going to bring on our next presenter. But a question here from Reed. He wants to know, are you seeing government restricting rent increases in mobile home parks?
Yeah, good question. So it's definitely a very state specific. In most of the states that we're operating in, there are no rent controls. That being said, you have to be responsible. These are people that if you raise the rent by $30, that's very impactful and meaningful for them. And so we need to make sure we're bringing value that justifies that kind of a rent raise.
Good. Rocco asks, do your properties have access to natural gas?
Good question. So mostly no. So we do have some properties that do, and that's certainly a nice feature. But most of the new homes that are produced do not have gas utilities. They're kind of all electric. So mostly no.
And Missy asks, how do you meet the opportunity zone improvement requirement? Is there enough with infrastructure and other improvements?
Great question, Missy. Yeah, so I won't go into all the details here, but as probably most people on this call know, that the basis is based on the improvements that you're purchasing, and typically, yes, through just lot prep, infrastructure repairs, new roads, club, all those sorts of things, we're going to meet that basis test pretty easily, and sometimes a multiple of that. The way to think about it is, again, if we're buying a community where we're paying for the cash flow, which is how these assets are trading, there's a huge value increase that happens as we fill them up. But based on our acquisition price, in a sense, we don't pay much for those empty lots, and so the basis assigned to the improvements that are there is sometimes pretty minimus.
And a couple more questions, and then I'll cut you loose, Sam. Brian wants to know, how long is the projected hold period?
So yeah, the hold period is certainly going to be the 10 years at a minimum, and we actually, I won't go into too many details here, but we are going to offer to our investors annually a chance for full redemption. However, we're also going to continue to operate these past the 10 years for those that want to continue to just kind of keep their money in the cash flow.
Good answer there. And then finally, we'll get to one more question. And there's several more that we're not going to get to, Sam, but I'll let you hang on as a panelist, and you can type in answers in the chat or in the Q&A section once we bring our next presenter in. But Mitch wants to know, is there the first year bonus depreciation applicable to your QOZ fund that I understand is available in mobile home communities?
Yeah, another great question. So yes, the bonus depreciation, we treat this the same as a non-OZ investment. And for those that aren't familiar, that's an amazing feature, I suppose, of a mobile home community, is that often our initial kind of year one K1 is going to have a 100% write-off of the investment because of the bonus depreciation. There's some nuances there in terms of the opportunity zone, because it depends on each taxpayer and their situation as to how and to when they can use that bonus depreciation.
All right. Well, hey, Sam Hales, thanks for joining us today. And Sam, as I mentioned, we do have a few unanswered questions still in the chat and in the Q&A toolbar. If you want to hang around and type in answers to those questions, please feel free to do so.
Awesome.
And for those of you out there who want to learn more about Sam's fund, please do visit saratogagroup.com, and you can register for the investors panel at invest.saratogagroup.com. So thank you, Sam.